We are. Listen, we're expecting a negotiated solution with China at some point, perhaps not Friday when the delegation gets here, but we do expect some combination of purchase commitments from China and decreased tariffs from the U.S. It just may take a little bit of a longer time frame than we expect, but let's not forget the strong earnings season that we just came through. We expected to go into earnings season with negative earnings growth, and we came out 3-4% positive. So we're still looking at fundamental strength here, which we think will drive stocks for the balance of the year.
But what happens to earnings expectations going forward if these trade uncertainties persist, as well as higher tariff rates?
Well, if you look at the way the market is trading right now, clearly disappointment in China was not priced in. Right, and so now that uncertainty is starting to become priced in. Uncertainty around the Fed is also starting to become priced in because, given Powell's comments last week about tenuous potential inflation concerns, we think the Fed could be a little bit more hawkish here. So some of the concerns, the binary concerns that we've had, have started to become priced in. We're going to see more volatility here. But again, we still see fundamental strength with the consumer, with a corporate environment, and we still feel good about U.S. equities at this point.
Erin, you're a little more concerned than Maddi, is that right?
That's absolutely right. So we're cautious here, and we've been running cautious risk over the last couple of weeks, and it's being driven by a couple of factors. Sure, the tough talk on tariffs definitely was the catalyst for the most recent sell-off that we've seen in markets, but underpinning that, we've also started to see some softness emerge. Stocks up until 2 days ago were up nearly 15-16% year to date, and the Nasdaq, they're up 20% year to date. We've seen a significant reversal in terms of multiples as well as price performance. And when you look under the surface, I think a lot of what's priced in right now is a really strong second half of the year, really strong continuation into 2020. And we aren't really seeing the cyclical pickup in growth that I think that the market's extrapolated expecting. And so for that reason, we think it's really prudent right now to take a little bit of a step back, reevaluate the price appreciation that we've seen year to date, and recognize that we're not really seeing a relift or a lift-off in terms of cyclical growth performance, as I think much in the market has already priced in.
But wasn't, Erin, the whole first quarter kind of about the fact that the economy is looking better than where we thought it was at the end of last year, and earnings are looking better than where the expectations were for an earnings recession, and therefore, actually, the growth picture for 2019 was shaping up to be better?
So I think the growth picture of 2019 is better than what was feared in late December of last year, absolutely. But we're still in an environment where the U.S. growth is falling back towards trend GDP, and we're seeing that really across the globe, across developed market economies. So this is not a re-levering of global growth higher. Rather, it's a sort of resynchronization of the U.S. growth lower to the rest of the world, more back to sort of trend GDP levels. And what we've seen coming out of PMIs, you look at the global PMI index that was released in April, we saw it tick down again. New orders continue to fall lower. So by no means do we think we're heading into a recessionary environment where you have to be really scared about, sort of a potential fall in GDP lower. But we're also not really seeing an accelerated liftoff in GDP either. What we're really normalizing to is a low GDP environment across, sort of developed market economies right now. And in that environment, I think the optimism that was priced into the first quarter was probably overly optimistic. Remember, even in the U.S., first quarter GDP that came out really strong, but about 0.7 of a percentage point of that was attributed to inventory, which is going to sort of reverse as we move into the second quarter of this year.